Hello and welcome to Darryl Company. Today, my guest is Jonathan Davis, CEO and founder of the Davis Companies, one of the region's largest and most successful real estate investment and management firms. John, thanks for joining us here today.
It's great to see you. Thank you for inviting me.
So, Jonathan, inflation and interest rates seem to be wreaking havoc with our economy today. What do you see as the effect on the commercial real estate market?
Well, there's no question that this doesn't require speculation because we're seeing it in real time. I'd say, and by the way, our firm is in the midst of a number of sales transactions, so I have very much real-time data. Speaking generally, I'd say that institutional quality core assets have been repriced somewhere between 5 and 10%, depending on the market, depending on the asset, depending on the income profile, and so forth. I think the impact is greater for land for development and properties that are suitable for heavy value add. Because of course, with costs going up, the margin, with costs going up and with values going down a little bit, the margins particularly on land for development are getting squeezed.
Right, that makes a lot of sense, and just general uncertainty makes people want to think long and hard about investments.
Yeah, I mean, I think the other side of it, though, Darryl, is that even though interest rates have gone up a bit, the yield to holders of fixed income securities are still pretty low, very low by historic standards. And what's happened over the last 10 or 20 years is that real estate, high quality real estate, and particularly in the favored asset classes, multifamily right at the top of the list, industrial there these days as well, and other asset classes as well, but especially multifamily and industrial have become fixed income surrogates. And so if you can get a yield on high quality multifamily property of 5 or 6%, that looks very attractive relative to the alternatives in the fixed income market.
So when you mention apartments, multifamily, and in industrial space, those seem to be the preferred asset classes are there right now. And because they give you a consistent stream of income, people are willing to look at that kind of like a bond. It's okay, it's going to keep coming. I know there was a little bit of a scare with urban apartments for a little while, but everything seems to have rebounded.
It's been interesting to watch. The forecasters assumed that it was going to take a couple of years for the market to recover from COVID and get back to the apartment rental market in cities like Boston and New York, and get back to pre-COVID levels. And it's snapped back much faster than I think anybody or most anybody projected.
And on the industrial side, I'm just kind of thinking, Amazon has taken a hit in the stock market. Do you think that like the close-in stuff has kind of hit an apex where maybe people will start going back to stores and don't need stuff delivered to their house every day?
It's interesting that you're raising this, and the timing is good. I read a report from Green Street, which is a research firm that tracks public real estate companies over the weekend. And they wrote a piece about the fact that Amazon was retrenching and their analysis of what they think it's going to mean. And they raised a couple of interesting points. First of all, last year, Amazon accounted for 40% of the demand for industrial space in the United States. It's just that one user could have that kind of a dominant position is really quite something. The other thing, to your point, that their study pointed out was that share of retail sales that are accounted for by e-commerce has really started to flatten out. And whether or not that is a trend that's going to last, or whether we're just seeing a desire of folks to go into the stores because they've been sitting in their homes for the last 2 years, it's quite possible. But at least at the moment, it looks like the retailers, the reports of the demise of brick and mortar retailers it has been exaggerated.
So what can you do these days to protect your investments during inflation and rising interest rates?
Well, I think this is probably both good news and bad news for the bankers. And that is that the number one thing to do is to only put moderate leverage on your properties. I think the other thing, or another thing, is that somebody said to me recently, a colleague of mine who runs another investment firm said, I don't think I have anybody that works for me that has ever entered an exit cap with a number higher than 5 in it in a set of projections. And that's something else that frankly we've been doing really through this entire period of lower interest rates, and maybe frankly to our disadvantage, because we've always assumed that there was going to be some reversion to the mean in cap rates, and so now we're finally starting to see it. For years and years we were wrong in betting on rising interest rates and rising cap rates. But if you did that, and you built your assumptions around a more normalized interest rate market, you're probably in a good position. And then the last thing I'd say, and it's something that we really focus on, and that's hands-on management and getting ahead of the leasing market, whatever product type you're in, and buttoning down your assets.
Good advice. And from a banker's perspective, we're okay with moderately leveraged properties, as you well know.
Right.
So makes us sleep at night.
Well, listen, we all need our sleep.
That's right. So where do you see opportunity in the market?
Well, first of all, we've been focusing, and I'm going to broaden the field of view a little bit. We've been focusing on the property types that are most affected by 2 meta trends. And one of them is changes in technology. And we've been talking about some of that. Certainly, technology has changed distribution dramatically, while e-commerce's share of retail sales may have gone down, or may have flattened rather. It still has gone from 0% to 15 or 16% of total retail sales in the last 15 years. I mean, that's enormous, and that has had enormous implications in the supply chain and in the pattern of distribution. I mean, the amount of warehouse space that's needed. We're essentially, if you think about it in the simplest terms, we're replacing retail space with warehouse space as we change the consumption patterns of our society. Another one where changes in technology are altering the supply and demand dynamics for real estate is in life sciences. And we're very blessed to be here in Boston, in one of the centers globally for life science research and development. And since the mapping of the human genome in the mid-1990s, the cost of mapping the genome at that time was $100 million, and now you can map someone's genome for $1,000 and get it done in 24 hours or less. And that's just opened up enormous possibilities. And I'm not a scientist, but from talking to the folks that we know who are, and also to the venture capitalists who invest in that space, we're in the early innings of discovery across all these different pathways. And so I think that, that's another place that we think is going to create, has created and is going to create enormous opportunity. The other force that we're very focused on is changing demographics. Certainly the baby boomers and their consumption patterns, but also the children of the baby boom, the millennials and the Gen Xers and the Gen Zers. Where do they want to live? Where do they want to work? How do they want to live? And that's fundamentally transformed the multifamily business. It's also created interesting opportunities in self-storage, and this is an area where we're very active as well. And this is not a big area of activity for us, but it's another one that we're working on, and we've done a dozen deals. They're just relatively small. Is the interest in drive-to vacations, the interest in seeing America first, the interest in outdoor living, healthy living, camping, RV parks, glamping. This is an area that has become a really interesting area of opportunity for us. So those are the property types that we're interested in, and I can tell you they're all firing on all cylinders. The one caution that I would put out there is that, and we talked about this a little bit with industrial space. There are some changes that you got to watch out for in industrial. We could be nearing a point of saturation, at least for the moment. At least there's some indigestion going on in last mile distribution. If I had to bet, I think that that percentage, that 15 to 16% of retail that's being consumed via e-commerce, I have a feeling that number is going to trend upward. It could take a little while. The growth could slow a bit, but I think the long term, the trend is still going to be positive. And in the case of life science, and particularly here in Boston, we're going through a period of adjustment. Just to put some numbers to it, we have in metropolitan Boston approximately a 40 million square foot lab market, and we have something like 40 million, these are very rough numbers, something like 40 million square feet in the pipeline. So it doesn't take a genius to figure out that the demand has to double in order to meet that growth if all those projects are completed. Now, they won't all get completed, especially if growth slows. And to that point, the biotech market is one of the areas of the public securities market that has been most adversely affected by, they had the biggest downdraft and that's saying a lot if you think about the way growth stocks generally have performed this year. And so it's getting harder for certain biotech companies to access capital. That's going to result in some downsides, already resulting in downsizing, layoffs, consolidation. And if you overlay that against this huge pipeline of supply that's coming on, it feels like that's a moment for caution.
I think that's really helpful. And I think our viewers are going to be happy to hear your advice. I kind of talk a little bit about that with my lending teams here, and always go very cautiously into that arena.
Look, Darryl, I think the way to think about this, these are very transformational, long-term trends, but they're not straight. The lines are not straight up.
Right. You know, with all this going on in the economy, and you're a very busy person, what do you do to relax?
Well, the answer I'll give you this week is different than it would have been a couple of years ago. My wife and I were very blessed to have 2 grandchildren during the last couple of years during COVID, and we spent a lot of time with them and built wonderful relationships with them. And I'm happy to say we've got a 3rd one on the way. So created a new chapter in our lives and in my life, which is very consuming and very gratifying. And I think, it's only going to get more fun over time. The other thing I'll tell you is that about 35 years ago, my wife told me, you don't have enough balance in your life, and I know you love the saxophone, so here, I'm going to buy you a saxophone for your birthday, and you should learn how to play it. And I didn't have the time, and I didn't play it. But 5 or 6 years ago, our son announced that he was going to get married, and I said to her, and she's a great piano player. I said, we should perform at our son and daughter-in-law's wedding. And so I spent 6 months and I practiced, and we performed a couple of duets at I played a couple of pieces at their wedding. Our daughter and son-in-law got married a year later, so I had another year of practice, and so I got better. So between my grandchildren and my saxophone, I'm pretty busy in my spare time.
Nice. Sounds like a great little hobby, and congratulations on the next grandchild arriving.
Thank you. I would recommend grandchildren to anybody who could get them.
All right, awesome. John, thank you for coming on the show today. I really appreciate you joining us.
Thanks so much, Darryl. It was fun.
And thank you all for watching Darryl and Company.